Gold just crossed $5,170 an ounce this morning, February 23, 2026, and the reason most people are celebrating is actually the same reason smart money is quietly getting nervous, because what just happened in Washington is not the end of the tariff story, it is the beginning of something far more dangerous. Welcome to the Capital Anchor. I break down what is actually happening in markets while mainstream media keeps you distracted. If you are new here, subscribe right now because what I am about to show you is going to change the way you read every gold headline you see this week. Here is what happened on the surface. The U.S. Supreme Court struck down President Trump's tariff powers last Friday, February 20th. The ruling specifically killed the April 2025 Liberation Day tariffs, which had placed a 10% minimum duty on all U.S. imports, with extra charges between 15% and 50% on dozens of countries. Markets responded with immediate relief. Equities jumped. Risk appetite climbed. Gold briefly dipped on Tuesday to $4,841. Then something strange happened. Gold did not keep falling. It recovered, fast. By Wednesday it was back above $4,992. By Friday, February 20th, it pushed to $5,047. And this morning, Monday, February 23rd, spot gold hit $5,170, up 1.3% in a single session, despite the court ruling, despite the supposed reduction in tariff risk. So the question you should be asking is this: if the tariff danger is over, why is gold still climbing? Because the tariff danger is not over, it just changed shape. Here is the mechanism. Most people completely misthink of tariff uncertainty like a leaking pipe inside a wall. The original leak, the Liberation Day tariffs, was visible. Everyone could see it. Everyone priced it in. Then the court came along and patched that specific section of pipe. The market celebrated. But the water pressure did not go away. It just redirected. And now nobody knows which wall is going to crack next. Trump announced on Saturday, February 22nd, that he would impose a global tariff of 15% using a different legal channel, now that the emergency powers route is blocked. The mechanism changed, the intent did not. And that uncertainty, the not knowing which legal tool comes next, is exactly the kind of environment where gold thrives. Now let me break down precisely why gold is doing what it is doing right now. Reason number 1. The US dollar is weakening at the worst possible time for dollar holders. When the Supreme Court invalidated the tariffs, traders immediately realized the U.S. would now lose over $175 billion in collected tariff revenue according to the Penn-Wharton budget model. That means the deficit gets bigger. A bigger deficit means more debt issuance. More debt issuance pressures the dollar. The dollar index fell after the ruling, which makes gold cheaper for buyers in other currencies and triggers immediate buying pressure from international investors. This is not a coincidence. It is a mechanical relationship. Reason number 2. U.S. economic growth is coming in weaker than anyone expected. Fourth quarter GDP just printed at 1.4% annualized. The market had expected 2.8%. That is not a small miss. That is a signal that the economy was already slowing before the tariff court ruling added a new layer of uncertainty. At the same time, the December PCE price index, the Federal Reserve's preferred inflation measure, came in at 0.4%, hotter than expected. So you now have slowing growth and sticky inflation. That combination is called stagflation, and there is no environment more bullish for gold than stagflation. Reason number 3. The Federal Reserve is stuck. Atlanta Fed President Raphael Bostic said on Friday that it is prudent to keep interest rates mildly restrictive, but with growth at 1.4% and uncertainty exploding, rate cuts are back on the table. Gold does not yield interest when rates fall or even look like they might fall. The opportunity cost of holding gold disappears. Traders are now pricing in potential Fed cuts again. That is a direct tailwind for the price of gold. Now here is where it gets interesting. While retail investors were watching the Supreme Court ruling and thinking the worst was over, here is what the big players were actually doing. Central banks globally are on track to buy 585 tons of gold per quarter in 2026. That is the projection from J.P. Morgan Global. Research published in February 2026. To put that number in context, you need at least 350 tons of quarterly net demand just to move prices upward in any given quarter. They are projecting 585, that is 235 tons above the minimum threshold needed for prices to rise. Every 100 tons above that threshold is worth roughly a 2% quarterly price increase. Do the math, that is nearly a 5% structural quarterly gain baked in before retail investors even touch the buy button. J.P. Morgan raised its gold price target on February 2 to $6,300 per ounce by end of 2026. Wells Fargo moved its year-end target to $6,100 to $6,300. UBS set a target of $6,200 by September 2026 with upside potential to $7,200. These are not fringe predictions, these are the desks managing trillions of dollars, and they are all pointed in the same direction. Meanwhile, the mainstream narrative this week is that the tariff risk is behind us. Financial TV anchors are talking about the Supreme Court ruling as if it resolved something. It did not. Trump has already announced he will pursue tariffs through a different legal route with a 15% global duty. The mechanism changed, the pressure did not. While retail investors are breathing a sigh of relief, central banks are still buying. Institutions are still repositioning. The dollar is still weakening, and gold mine supply is effectively flat, with U.S. mine production at 0 new openings since 2002. The big players are not waiting to see what happens next. They are already positioned, and the data shows it in the price. But here is what most people completely miss: the historical pattern. Behind what is happening right now is the single most important piece of information for understanding where gold goes from here. Let me show you the last time this exact setup played out, because history does not repeat, but in gold markets, it rhymes with remarkable precision. Cast your mind back to August 2018. The US-China trade war was escalating. Tariffs were being announced, then challenged, then rerouted through new legal mechanisms. Sound familiar? During that period, gold initially fell from $1,360 to $1,174. Retail investors panicked and sold. They thought the chaos was a negative for gold. Then something shifted. By the time the Federal Reserve paused rate hikes in January 2019, gold rocketed 17% in under 5 months, reclaiming all losses and setting up for the 2020 run to $2,075. The pattern was identical to today: initial confusion, retail selling, then a massive, sustained institutional accumulation phase. That retail investors almost entirely missed. The people who understood the mechanism made life-changing gains. The people who watched the news headlines got left behind. Now here is what has not changed, regardless of the tariff noise. First, central bank demand is structurally locked in. Countries across the BRICS bloc, led by China, India, Russia, and Turkey, are actively reducing dollar reserves and replacing them with physical gold. The People's Bank of China added gold to its reserves for the 16th consecutive month as of January 2026. This is not a trade. This is a multi-decade policy shift. No court ruling stops that. Second, real interest rates are declining, with growth slowing to 1.4% annualized and inflation sticky at 0.4% monthly PCE. The Federal Reserve's room to keep rates high is shrinking. Lower real rates are directly correlated with higher gold prices. Every 25 basis point cut the Fed signals adds roughly $60 to $80 to the gold price based on recent elasticity data from Goldman Sachs. Third, mine supply is not growing. Global gold mine production grew just 0.5% in 2025. No major new mines are expected to come online before 2028 at the earliest. Demand is rising. Supply is flat. That imbalance does not reverse itself because a court issued a ruling. Fourth, the dollar's reserve status is eroding. U.S. national debt crossed $36.4 trillion in February 2026. The U.S. now spends more on interest payments than on national defense. Foreign holders of U.S. treasuries, particularly Japan and China, are reducing their exposure. When the world trusts the dollar less, it needs gold more. Now I am going to go on the record. Screenshot this. By September 30, 2026, gold will reach $6.300 per ounce. The mechanism is already in motion. Central bank buying above 585 tons per quarter, declining real rates, dollar weakness, and the ongoing rerouting of U.S. tariff policy through new legal channels will keep uncertainty elevated. Elevated uncertainty is the single most consistent driver of gold price appreciation in recorded modern history. That target is not speculative. It is the mathematical output of the demand and supply data that already exists today. Now let me give you 3 scenarios with probabilities so you can plan accordingly. Scenario 1, the base case, probability 65%. Tariff uncertainty continues through Q2 and Q3 2026. The Fed signals 1 or 2 rate cuts. Central bank buying holds above 550 tons per quarter. Gold reaches $5,800 to $6,300 by September 2026. This is the most likely path. Scenario 2, the accelerated breakout, probability 25%. Trump successfully implements a 15% global tariff through executive order, triggering a fresh wave of global uncertainty. The dollar falls sharply. The Fed cuts twice before July. Gold breaks $6,500 and potentially tests $7,000 by year-end 2026. Scenario 3, the reversal, probability 10%. A full US-China trade deal is announced, tariff threats are completely abandoned, the Fed holds rates steady, and dollar strengthens sharply. Gold corrects to the $4,600 to $4,800 range before finding support. This is possible but requires multiple simultaneous tailwinds reversing at the same time. Now let me speak directly to whoever is watching this right now, based on your situation. If you are holding physical gold already, the data says hold. You are positioned correctly. Do not let short-term volatility shake you out. The institutions buying at $5,000 plus are not planning to sell next week. If you are using leverage or actively trading, be aware that gold at these levels can see $200 to $300 intraday swings. The trend is your friend, but tariff headline risk can create violent short-term reversals. Manage position size. Do not bet the account on a single catalyst. If you are sitting on cash on the sidelines, you are not late. A 65% probability base case scenario with a $6,300 target from $5,170 today still represents over 21% upside. The window has not closed, but waiting for a perfect entry in a structural bull market is how people miss the entire move. If you bought near the recent highs and are feeling underwater on a short position or a leveraged bet against gold, the data is working against you. The structural forces here, central bank demand, dollar weakness, stagflation risk, are not short-term. Reassess the thesis, not just the price. Now here are the 4 indicators you need to watch from this point forward. Watch the DXY, the US dollar index. If it breaks below 99, gold is going to accelerate. If it recovers above 104, expect a gold pause. Watch COMEX gold inventory levels. When registered inventory falls, it means physical delivery demand is rising. That is a signal of real, not speculative, buying pressure. Watch Federal Reserve meeting minutes and dot plot revisions. Any shift toward cuts will be a direct green light for gold. Watch central bank purchase reports, particularly from the World Gold Council monthly updates. If quarterly buying stays above 500 tons, the floor under gold is intact. Now I want to talk to you directly for a moment. Right now, there are 3 types of people watching this video. The first type is panicking. They saw the Supreme Court ruling. They thought the gold trade was over, and they either sold or are about to sell. They are about to make the same mistake retail investors made in 2018. The institutions are counting on it. The second type is frozen. They know something big is happening. They can feel it, but they are waiting for certainty before they act. And certainty, in markets, always arrives after the price has already moved. The third type is the one learning right now. They are watching the mechanism, not the headline. They are tracking what the big players are doing, not what the news anchors are saying. They understand that tariff uncertainty did not end. It just changed shape. Markets do not destroy wealth. They transfer it, from the impatient to the patient, from the reactive to the prepared, from the people watching headlines to the people watching mechanisms. Every time the mainstream media tells you the gold story is over, institutions are quietly accumulating at the exact prices retail investors are walking away from. Gold climbed today for the same reason it has climbed for 5,000 years. When governments cannot agree, when legal systems are being tested, when currencies are under pressure, human beings reach for the one thing that no government can print and no court can invalidate. That was the premise of this video when we started. and the data just proved it true. If this broke something open for you, hit subscribe. Share this with one person who thinks the tariff situation is resolved and is not paying attention to gold right now. They need to see this, and drop one word in the comments right now. Type mechanism if you are the third type of person. I want to know how many of you are actually paying attention. This is the Capital Anchor. I will see you in the next one. This video is for educational and informational purposes only. It is not financial advice. Always do your own research before making any investment decisions.